Right now, something doesn't add up. Stocks are near all-time highs. Investors are confident. Financial media is optimistic, but under the surface, liquidity is tightening. Corporate insiders are selling. Consumer debt is exploding. Historical indicators that predicted previous crashes are flashing again. And now let me be clear. This is not fear-mongering. This is pattern recognition, because before every major market downturn 2000, 2008, even 2020, the warning signs were visible. Most people just ignored them. The question is, are we doing the same thing again? Let's break this down carefully. The first warning sign is valuation. When stock prices rise much faster than corporate earnings, risk builds quietly. Historically, when price-to-earnings ratios stretch far beyond long-term averages, returns over the next few years tend to shrink dramatically. This doesn't mean a crash happens tomorrow, but it does mean expectations are unrealistic. Before the dot-com crash, investors believed tech stocks could only go up. Before 2008, people believed housing prices could never fall nationally. Volatility was at historic lows, and markets looked stable. Every bubble feels safe until it doesn't. And right now, we're seeing heavy concentration in a few mega-cap stocks, retail investors aggressively buying dips. Record levels of passive investing. When too much money flows into the same trades, the system becomes fragile. It works beautifully until liquidity pulls back. And that brings us to the second warning sign. Markets don't move on hope. They move on liquidity. When the Federal Reserve injects liquidity into the system, asset prices rise. When liquidity tightens, risk assets struggle. We are in a higher interest rate environment. Borrowing costs are elevated. Credit conditions are tighter. Banks are more cautious. And when credit slows, economic momentum follows. Here's the key idea most investors miss. Bull markets are fueled by easy money. When money becomes expensive, valuations compress. This doesn't happen overnight. It happens slowly, then suddenly. And historically, major corrections often begin when investors are still confident. The surface looks calm, but underneath, pressure builds. Another major signal: pay attention to what insiders and institutions are doing, not what they're saying. Corporate executives understand their businesses better than anyone. When insider selling increases while retail buying surges, it creates a divergence. We've seen this pattern before in previous downturns. At the same time, hedge funds are increasing hedges. Bond markets are pricing economic slowdown risks. Defensive sectors are quietly outperforming. Smart money reduces exposure quietly. Retail investors tend to increase risk near market peaks. It's not about intelligence, it's about emotion. Fear dominates bottoms, greed dominates tops, and right now, greed is rising again. Consumer debt levels are high. Credit card delinquencies are rising. Small businesses report tighter financing conditions. Commercial real estate faces refinancing pressure. None of these alone cause a crash. But markets fall when multiple stress points align. And the alignment is starting to form. Remember, markets are forward-looking. They don't wait for headlines to confirm recession. They price in risk early. By the time news becomes obvious, prices have already moved. So does this mean a crash is guaranteed? No, but risk is elevated. And elevated risk requires preparation. Here's what disciplined investors do during uncertain periods. Review portfolio concentration. Avoid excessive leverage. Keep liquidity available. Focus on quality balance sheets. Have a volatility plan in place. Preparation is not panic. It's professionalism. Because the next correction, whether it's 10% or 30%, will reward those who stayed rational and punish those who believed markets only move in one direction. Every major crash in history started with the same belief. This time is different. Maybe it is, maybe it isn't. The warning signs are here. The data is visible. The patterns are forming. The only question left is, will you ignore them or prepare for them? If you want serious market analysis without hype, subscribe now. Because when volatility returns, preparation will matter more than prediction. Like this video if you believe smart investing means thinking ahead. And I'll see you in the next breakdown.